Hello and welcome to this Tolley Seminars Online lecture. We're going to be taking a look through some of the main areas involved in making tax digital. HMRC published their MTD roadmap last December and set out plans to make the tax system much more computerised by 2020, and they at the same time dropped the term making tax easier to making tax digital. So does digital mean easier? They obviously had some concerns about that. Now, one of the major controversies, of course, in all of this is over the mandatory quarterly reporting and the lack of simplification of the tax system, and also points around agent access. We'll talk about those because we do have a chance to respond to HMRC's consultation in this area. Now, on the 15th of August this year, HMRC published 6 consultation documents which were delayed as a result of the referendum, and we now have a period until the 7th of November 2016 to submit our comments on them. Concessions to small businesses were announced jointly with the Federation for Small Businesses. Consultation document number 1 deals with bringing tax into the digital age and applies to all self-employed landlords and unincorporated businesses. And basically what they're saying is that those businesses will need to acquire approved software which keeps their records digitally, and then those headlines of those digital numbers will be required to be filed with HMRC. In other words, it will not necessarily be acceptable to keep your records in nicely handwritten cash books or on Excel spreadsheets, although HMRC are, as part of the consultation, consulting over transitional help for people who use paper or spreadsheet type products. The idea is that agents, i.e. accountants, will have software to interface rather than directly access their clients' affairs. So in other words, agents, the likelihood is that agents will have access to the information that's contained on their clients' digital records and will be able to interface with it, for example, for checking that the information is correct, etc. But obviously, for practical reasons, HMRC is saying that they wouldn't have direct access in to that software, because that means that there may not be a way of tracking whether the agent posted something or whether their client did, and that would obviously be a practical difficulty in determining who made a particular mistake. HMRC have relented on their original plans, where they actually said that they would want all of the digital records to be filed on a quarterly basis. Now they're saying they only want summary quarterly updates of key figures, and then 9 months after the end of the year, you could then do a reckoning up and send in sort of a fully adjusted set of accounts. So you might, for example, do a light touch sort of cash style filing for quarters 1, 2 and 3. Quarter 4, you might do another quick cash one, but then you've got 9 months to then prepare a full and proper set of accounts, which would then make an adjustment, and that would then determine your income for that particular tax year. There is the exemption where the turnover of the landlord or the self-employed individual is below £10,000. That's not a particularly generous limit, because, of course, that's not even income covered by the personal allowance. And they're consulting on a wider, of this being made a wider exemption, and talk is being levied of something like equivalent to the VAT threshold of 83,000. But time will tell what level they decide that exemption may apply to. The second consultation deals with simplifying tax for unincorporated businesses, where the cash basis may be made available for turnover of up to £166,000. That's twice the VAT threshold. There'll be upfront relief for most non-property expenditure to simplify the capital and revenue distinction, and potentially the removal of the year-end. Once we go on to perpetual quarterly filing, you won't need a year-end. That said, you will need to somehow find a way of mapping your 4 quarters to a particular tax year, because it's the tax year to which we apply things like personal allowances and, of course, how we assess other income, like employment income or other types of income. In that situation, HMRC are talking about, if they do remove the need to have this basis period, this accounting period, that then if you do change your basis period, you will not be allowed to relieve any overlap relief you've got brought forward. And therefore, with a client that has a year end other than the 31st of March or 5th April, will have already got some overlap relief, whether that's transitional overlap relief arising in tax year 96-7 or actual overlap relief if they started their business anytime from the 6th of April 1994, they will no longer be able to relieve it if they change their accounting date anytime after April 2018 if you're a bigger, smaller business, or 2019 if you're a small business. Big, small and small are yet to be defined. So advice that you might want to give if your client is carrying a lot of overlap relief, you may decide to change their year end by doing a shorter accounting period up to the end of March, which would relieve all of their overlap relief brought forward, and do that sooner rather than later in case they do go ahead with their proposal and remove the availability of overlap relief in that situation. Consultation document number 3 is on the simplified cash basis for unincorporated property businesses, where they're saying they are thinking of extending the cash basis to most types of landlords, maybe even without a turnover threshold. In other words, the normal method of measuring property income will be by cash basis. I think this might be done by default by landlords anyway, because I'm not sure many landlords preparing very simple accounts for property income actually know how to do gap accounts in any event, but that might disappear. The fourth consultation document is something that HMRC has said that they've had some preference shown by some taxpayers, and that is where if you are declaring to HMRC on a regular basis, on a quarterly basis, what your income and profit is, that you might actually opt to make regular payments of your tax liability. And this consultation deals with how to manage and allocate the different taxes when you pay as you go. Currently, they are not proposing changes to required payment dates, and they make no mention as to whether if you do pay earlier than the normal required payment dates, whether they're going to give you any sort of credit interest or some sort of incentive payment. Time will tell. But the advantage for some taxpayers is that if they are not very good at saving money to pay their tax, and each January and July comes round and suddenly it's a big surprise that they have to pay their tax, every time they file on a quarterly basis, whilst the money is in their bank account because they've only just earned it, if they just made a payment over of the profit they've declared, they will always be keeping up to date with their tax and less likely to have future problems with HMRC. So I can see some sense in this, and whether this voluntary payment system becomes popular and they make it compulsory is something we'll know down the road. The fifth consultation document deals with the tax administration. And what they're looking at is introducing a points type of system, like your driving licence, for non-deliberate failure to submit something on time. And it's only when you sort of build up a number of points do you actually then start getting proper penalties. There'll be a stronger sanction if you deliberately do it, and obviously that would be something that HMRC will need to build a bank of evidence on. There's also an idea of building a new penalty interest regime proposed, and 2 possible models for aligning existing late payment dates. They're looking at a phased approach, but I think a sensible, pragmatic approach of introducing a point system whereby you get a certain amount of sort of lives, as it were, before you actually have to start paying, does seem a sensible system, because I know from the work that I do with many small business owners, they don't deliberately file late or deliberately get their tax wrong. They just simply make a mistake, or something happens in their life, and at that point in their life, tax isn't the most important thing on their mind. They may have a bereavement in a family or a family crisis to deal with, in which case, why suddenly be landed with a £100 penalty because you didn't get a quarterly filing in on time, and that's the first time you've done it for a very long time. So it does make a lot of sense. And finally, the last consultation document deals with a better use of information, where HMRC are looking at improved use of existing information from third parties, which will be then fed through into your personal digital tax account, such as your PAYE information, bank interest, in time, it could be listed company, share dividends, etc. And in time, they will actually get where information comes from a reliable source, they will auto-populate your personal tax account, and then your business tax account will obviously have your business information. And once that you've populated your sort of 4 quarters and your annual adjustment, that will then find its way over to your personal tax account, and that will set the basis of how much tax you owe for that specific tax year. So, when looking at the world going digital, it's always worth us asking ourselves, what do our clients want? What do taxpayers actually want at the end of the day? Well, in my mind and my experience, our clients want two things. Firstly, to sleep at night and ask themselves, have I complied with all these obligations that are required of me? Because one thing I do know of small business owners, they start their business because they enjoy doing what they're starting a business in, or want to make money out of it, or both. Ideally both in this ideal world. But they don't start a business because they want to comply with a whole load of red tape from HMRC. So what they want to do is to be able to comply easily and want to know how likely it is that HMRC will start an investigation or an inquiry. And are there any reputational risks if they do? In that situation, basically what the individual wants is to be able to sleep at night knowing that they can easily comply and they have complied, and that HMRC will leave them alone. And at the end of the day, if a business is fully compliant, HMRC will leave them alone because they've publicly said it's not in their interest to chase people who are compliant. They also want to know that they paid the right amount of tax, and this is where there might be controversy, because HMRC sometimes think that the right amount of tax is the absolute maximum you could pay. But what a taxpayer really wants to know, and this is where the advisor has a very big role in the affairs of small businesses, is to ensure that small businesses and individuals claim all of the reliefs and allowances to which they are entitled to rightly within the law. Client, as long as the client says, well, I've claimed all the right amount of allowances, I've complied with my obligations, they can sleep at night knowing they're paying the right amount of tax, and that HMRC are not going to come knocking on the door later on. Now, how are HMRC going to use all this big data? Well, to a degree, they're already using information like this already. So what I call spotting outliers, where they might, in time, we might be required to file our information to HMRC against a specific SIC or industry code. And what that will do is HMRC will say, for this type of business, we would expect their turnover and their tax paid to be within a certain acceptable band, which on the screen in front of you would be that sort of within that green circle. Where a business files information which is outside of those, then it could trigger one of HMRC's risk triggers, and they might inquire. And particularly we're looking at the two crosses that are further down below the green circle. In that situation, HMRC are thinking, hang on a minute, they're not paying the amount of tax that we'd expect them to pay, and in that situation we'd actually ask them why. Are they not declaring all of their income? Are they overclaiming expenses? I'm not sure that HMRC will necessarily be interested in writing to them if they are in those two X's above the green circle, because in that case they paid more than HMRC would expect them to do, and I'm sure that HMRC might leave them alone. But we, of course, as an advisor, would hope that our software would trigger that as an opportunity and for us to ask our client as to whether they are giving us details of all their expenses, because they seem to be paying a bit more tax than the norm, and we may be able to collect that data through our own software packages. Now, it's fair to say that the digital age is going to be the biggest challenge that this profession will ever face. But we've faced self-assessment, we've faced online filing for a many long time, and this profession has survived all of that. Whilst it's fair to say that there could be further commoditisation of tax services, particularly in the compliance space, I do believe that the role of the advisor will be absolutely critical, in that we will need to add value to that compliance process by, as I mentioned in the previous slide, ensuring that our clients are properly advised and are claiming all of the reliefs and allowances to which they are entitled to. Our job will move from simply entering data from one system into another and preparing it from a set of accounts, a tax return. Basically, the business tax information will be prepared already. Our role will be checking that information, sitting behind the client, checking before it goes into HMRC that it looks correct, it looks complete, and that HMRC will not want to inquire into it. In other words, halting inquiries before they even begin. And of course, helping clients through this transition, especially those clients who are currently not digitally native, not keeping their records on appropriate accounting software, but instead using manual books and records or spreadsheets. We'll actually have to help those clients move into the digital space. We may need to reskill and empower our tax department to provide new ways to add value, and that is actually acting as advisors to businesses on how they keep their records, not just on doing their tax return in a particular piece of software. I think in time, further automation and artificial intelligence will help us do our job better by spotting those outliers and spotting those opportunities to give advice. And that will in turn affect training, development and indeed qualifications for people studying in tax. So it's fair to say we do live in very exciting times, and I'm sure we'll embrace these changes wholeheartedly, because if we don't, they will only be there to crush us. So change is opportunity, and there'll be plenty of ways for us to help our clients, not just once a year, but 4 times a year, and keeping regular contact with clients will help us continue to give the best possible advice and guidance to those many small businesses that need us. Well, many thanks for listening to this lecture. My name is Chris Jones, Director of Tax Markets at Tolley.